For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning and welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name's Jeff Shade, and as always, I'm just here to ask the questions, but of course the words of wisdom and solid advice, well, you know where they come from. They come from Randy and Jake Floyd of Floyd Financial Group. I'll start with you, Randy. How you doing this morning, my friend?
Doing very well, Jeff. Just happy to be here.
Yeah, likewise too. And Jake, how's this Saturday morning treating you?
I'm doing great, Jeff. Thank you for asking.
Always glad to hear that. I hope our listeners are doing well today, too. Glad to be on the radio here in the last bastion of sanity, Springfield, Missouri, and glad for our listeners. We do hear from them once in a while. If you've got questions or comments about our show, we would love to hear from you. You can get those comments or questions to us two ways. Either you can go to the website, floydfinancialgroup.com, or you can give us a call, 417-889-7233. Okay, a full docket today on today's Register, gentlemen. Let's start off with talking about current events. And I know that this is a beginning pretty much of the second quarter. What do you think about what's happened in the first quarter, and can we even give a market forecast, so to speak, for the rest of the year?
Yeah, so Jeff, the last quarter, in fact, the last quarter and a half has been pretty strong, and corporate balance sheets, revenues, profits have all held up really well. Some of the conversations I've been having with clients in the office when I do my reviews is, when is this inflation thing going to end? And one of the things I've been telling people is, I think what happened, I think there was a lot of CEOs and people that were around for the late 70s and 80s that are still out there, and then some of their, what would you call them? They're people that learned from them.
Lackeys?
Well, not lackeys. Their mentorees are there. And they realized what happened was companies got way behind the eight ball with inflation that time. And I think when it rolled around this time, they said, you know what? We're going to prop this up. We're going to outpace inflation rather than trying to catch up after we get buried. So I think that's why we've seen inflation linger and stay high for a while. A lot of people say, well, when are we going to end this inflation? Two things happened. We printed $6.5 trillion and put it into the system. We put too much money in people's pockets. Early on, we had supply chain problems. We couldn't get products, so that drove prices higher. Now what we have is we still have a lot of money running around in the system out there, and people are still willing to pay those high prices. I will tell you, I had an aha moment myself here a couple of weeks ago where I was looking at two brands of shredded cheddar cheese. Now, I like a little cheddar with my burritos and stuff. So anyway, I'm looking at this, and this one brand that I used to be really loyal to because I worked there for a very long time, I looked at that. The pound bag of shredded cheddar was $5.48. I looked at the other one, and it was $3.98. Well, that's a 37% difference. And I said, you know what? I like that company, or I did love that company, and it did me well, but I've had it. I've had enough. I'm going to tell you, when the American consumer says we've had enough, inflation will right itself. Yep. As long as people are willing to pay and the demand is strong, companies are not going to cut their prices. We've tried to curtail it with interest rates and things, and it's had some impact, but here's the bottom line. When people get sick and tired of being sick and tired, and when the pain of change, right, is greater than the pain of staying the same, that's when people will change. So I think it's coming, but it's just kind of interesting how things are playing out.
If I'm hearing you correctly, I think what you're saying is that in some cases, prices are artificially inflated.
Yeah, I think that, like Randy said, I think that these corporations have realized now that nobody's batting an eyelash whenever they raise prices 5%, 10% every other month. And so, why would they stop if it's padding their pockets if everybody's still paying? And I mean, I totally agree with what Randy's saying. I think it's the same argument that I think people should be making that make $12 an hour welding. If you just say, no, I won't do that for $12 an hour, they'll pay you more. As long as they have their coffers full of people doing hard work for $12 an hour, they're going to keep doing that. It's the same way with prices. Once we say, hey, I'm just not paying that anymore, they will figure out a way to get prices lower. But right now, it's just padding their pocketbooks. It's part of the reason why markets are at all-time highs is because prices are up, profits are up, therefore revenue's up, therefore the stock price is up. So Until that changes, until people run out of money to spend, when they can no longer go hit their piggy bank called their house, which, by the way, if they lower interest rates later this year, will create another surge in inflation, most likely, because of the housing industry. That people will go and refinance, tap their house equity so that they can continue spending into oblivion. If that happens, I don't think we're done with inflation yet, I guess would be maybe the short way to say it.
What do you think about raising the minimum wage for fast food workers in California to $20 an hour?
So I think Gavin Newsom is a self-serving governor of California.
Easy.
I said governor.
Easy.
Well, he's in the restaurant business over there, and of course, well, he is. And so anyway, it was for 60 chains of 60 restaurants or more, unless you bake your own bread. What in the world? I was reading this law the other day, and I'm thinking...
And let me guess, all his restaurants bake their own bread?
Probably. I don't know. But, what does that have to do with anything? There's been some restaurants just close up shop because they're saying, at $20 an hour that they have to pay, they just can't do it. In many cases, I think that was a raise for people of almost $6 an hour. Puts people at $41,000 a year to turn hamburgers on a grill.
Right.
I just don't think the economics of that make any sense.
Well, and, you're just going to see the price of a burger go up by roughly 30-40% over the next year or so when they have to pass that along to consumers. The food business is a very low-margin business. You just can't absorb a 30% increase in your labor cost. That you go from a healthy business to closing your doors a year later with that kind of an increase. You just can't support it. I think most of the people calling for just raising the minimum wage really don't understand what they're asking for. And it really doesn't change anything. It just inflates the cost of everything else. In fact, the people arguing it are actually the ones paying for it because they're the ones that aren't affected, a lot of them, by, we have the virtue signaling of some of these people where, hey, I'm a doctor, I make money, we should definitely raise the minimum wage, right? And all that happens is those people get paid more, the cost of everything goes up. It just doesn't really change anything.
We're talking with Randy and Jake Floyd of Floyd Financial Group, and we're talking about current events in the news today. We've talked about the market forecast. Let's shift gears here a little bit. Talk a little bit about AI stocks. I understand that they're being propped up. What is propping up AI stocks?
Well, basically, it's kind of like when we had COVID and we had all the money hit the system and we had, remember Zoom, I think, Jake, went from like $50 a share to 500.
20 to 500.
Oh, 20 to 500. And now I don't know what it is today, but it went way down from 500 back to like in the 60s the last time I looked
Zoom
at
is
it.
about 65 right now.
Yeah, so, we saw a lot of speculation, and we have a lot of speculation around the AI. Now, here's the thing I will tell you. The AI thing scares me on the one hand. Number two, it's here to stay. And number three, it will carve out its niche in boosting productivity in certain areas where companies will not be able to afford some of the wages that may be inflicted by governments.
Especially as we're raising the minimum wage to $20 an hour, depending on what it is.
Right. AI is here to stay, no doubt about it. I think one of the things that's going to be really interesting to watch is how they go about regulating some of the stuff that's probably going to happen. Because, Jeff, here's what we know. People are the problem in every situation, but they're also the answer, right? And so we know that as we build AI, some people will use it for good, and others will figure out, hey, here's a good way to profit under the radar.
Finally, I understand that there's poo in the news. I can't wait to hear what that's all about.
Yes, I was reading this morning that some companies like Whole Foods and a company called Green Forest, believe it or not, here you go. Are you ready? A company called Who Gives a Crap and a company called Real Paper are talking about how we're killing too many forests, and they want to start using, and they are using, bamboo to make toilet paper. Now, I don't want to get off in the weeds too much here,
right,
but they said that the length of the strand of the fibers in the bamboo lend itself to strength and softness. And so it's something that people are going to embrace more and more. But it did talk about the fact that the reason they want to go this route is that bamboo completely regenerates itself and they can reuse that same stalk or a similar stalk every 3 years, where right now it takes about 20 years for a tree that we would remove to make paper out of to regenerate itself. So I guess maybe it holds some water or other things to think about. And so I just thought it was
stranger than fiction sometimes.
I just thought it was funny, that we're going to be using bamboo
for that purpose.
For poo.
Yeah. So basically what you're saying is we shouldn't be out gobbling up these bamboo stalks right now. It's a little too early for that.
That's probably true.
Randy or Jake, have you ever been to Europe? I mean, in many places there, they don't use toilet paper. They have a whole different thing. It's like a tighty-toity or something like that. Maybe that's what we need in this country.
I have not been to Europe myself, but I do understand that, yes, they do have many different methods over there, including sidewalk places for men just to kind of walk up and do their deal. So I don't know. Anyway, I'm glad to be an American, like Jake said.
Yeah, I'm going to echo that sentiment too. Talking with Randy and Jake at Floyd Financial Group, we're talking about current events. We're glad you could join us on this week's show. Once again, if you'd like to sit down with Randy and Jake at Floyd Financial Group and talk about your individual situation, if you're not sure you're on the right path towards a confident retirement, we are offering a no-cost, no obligation, and no judgment Floyd Financial Group Retirement Review. To get yours, call 417-889-7233. It's 417-889-7233. It's a no-tie zone, just a chance for you to sit down with Randy and Jake there at Floyd Financial Group, get the questions answered that you need the answers to put you on a path towards a confident retirement. Once again, it's not going to cost you a dime, so make that call this weekend. Leave your name and your telephone number. Ashley will give you a call back during the week and set you up with an appointment with Randy or Jake there at Floyd Financial Group. Once again, that telephone number, 417-889-7233. You can also request your plan online at floydfinancialgroup.com. It's floydfinancialgroup.com. Gentlemen, time for a break. When we come back, we're going to begin a conversation here about what a well-rounded financial plan consists of. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about the building blocks of a sound financial plan.
And it's just like building a house, Randy. I mean, you need a solid foundation. Everything else falls into place after that. So let's talk about the building blocks of a solid financial plan. I would imagine that the first thing to do is to design an income plan.
Yeah, you know, Jeff, I mean, income is a very important thing if you want to continue to live.
And eat, yeah.
That's right. It's one of those things that there's a lot of ways to approach this. But yes, income is very important. But I will say this, there are two different ways of approaching income. One of those is there are people that like to set up income streams that just are, hey, it's my income, it's a guaranteed process, and I don't care about any additional liquidity. And then there are those others that would say, well, I'd like to have additional liquidity so that if I want to buy a new car, if I want to buy a lake house, if I want to take a trip to Europe, if I want to take my whole family to Europe, if I want to spend an extra $50,000 this year, or maybe an extra $100,000 the first couple of years I'm retired, there's different ways to set these things up. And there are caveats to both. But I will tell you that a well-rounded, thought-out plan will give you all the above. It'll give you income that you can't outlive, access to funds when you want to do those special things, and ultimately provide for your spouse in the event one of you should predecease the other early, and then finally leave something for your kids if that's on your radar. Now, I have people on both ends of that spectrum, Jeff. Some people say, you know, I want to do everything I can to leave $1 million to my kids, and then I have other people that say, I want my last check to bounce.
So anyway, let's talk about that income plan. That's very important because I think that is the basis of everything. Without an income plan, of course, you're going to be dead in the water. So the sources in the income plan, most people have Social Security and pensions, right? How do we maximize Social Security and how can we affect pensions so that we get the most amount of money?
Yeah, so Social Security is one of those things. It's a huge football item, and you probably know this, Jeff, and a lot of people listening have probably heard and seen all these commercials and stuff online about, you know, how is the best way to file for Social Security?
Right.
Because there are so many variables that can come into that. However, I will tell you that when you boil it all down, it comes down to a couple of things. Number one, do you know how long you're going to live? Well, none of us really know that. Number two, what is your situation right now, maybe health-wise? Maybe you need to retire and maybe you need to take that income. Maybe you need to go to part-time or something. It's not just an age-related thing. Many times you can go out on the online and you'll type in, when's the best time to take Social Security? And almost invariably you will get, well, you need to take it at age 70. While yes, you get the maximum benefit at age 70, that doesn't always necessarily mean it's the very best thing for people because a lot of times and many times by waiting to take it till age 70, you better live to your mid-80s to get even on what you gave up by not starting earlier than age 70. So it's always one of those things where there's no two people that are the same. When people come in and we sit down and we're looking at when to take Social Security, there's a lot of factors that come into play, and we just have to do it really a custom plan for each couple or individual.
I think when we see those plans that say wait till age 70, I think at the bottom it'll probably say sponsored by the United States Treasury.
That's right.
Janet Yellen.
Janet Yellen says, don't take it. I need it more than you do at this point. So that's going to be the foundational building block, is going to be Social Security and maximizing that. Not a lot of people have pensions, but if you do have a pension, there are some ways that you can maximize that. Am I wrong or right about that one?
No, for sure, Jeff. I think the last number I saw was about 16% of Americans still have access to a pension plan. So a couple of things to note. Many of those pension plans, you have the option to have a lump sum buyout, or you can take that pension over many different setups. Some of the basic pension setups are, the biggest payout is when you take it for, let's say you're an employee for a government entity and you're retiring. If you take it for your lifetime only, so that's a life annuity, gets you the largest payout. Then the next one is, well, okay, maybe I want it to go to my spouse. And sometimes you can get it to where 100% of it goes to the spouse. And many times it's graduated. It may be that you only get 75 to your spouse or 50% to your spouse. So that's something we have to consider. The other thing is we can set it up to where it says, well, you know what? This thing will pay you this amount for exactly 10 years or your life. So what does that mean? That means if you die early, your spouse gets the remainder of whatever those first 10 years are, but then that benefit is gone. The other thing that you have an option to do is to take a lump sum payment and invest it yourself and set up your own pension or put it in an investment portfolio. So there's many, many different moving parts to this. Also, I will tell you, when we start looking at pensions, we have to look at certain sectors of the government and law enforcement and firefighters and people like that get special consideration on when they have access to some of these lump sum pension funds if they want to move them. So this whole thing is kind of a can of worms, and really I'm not trying to confuse people as much as I'm saying I want people to understand that, Social Security is not just Social Security. A pension plan is not just a pension plan. How you structure and how you use these things makes all the difference.
And I don't know a lot of people who can live off of just Social Security or Social Security and a pension. So that brings me to the next source of income, and that may be a 401k. So what can you do with a 401k in maximizing the income from that?
How many days we have on this show?
Yeah. We've got about I had just about 40 minutes left here, guys. So
Okay. All right. We'll keep it brief.
We'll boil it down.
Yeah, sure.
So, the 401k plan is one of those things that really became popular in the 80s and the 90s. And now, of course, the mainstay of most people that retire. A lot of people don't have pensions, as we've already alluded to. But, prior to that, only wealthy people invested in the stock market. But the 401k gave people the ability to do that. And, of course, that's what ultimately reduced pensions and took that corporate responsibility away from companies. And today it rests solely on the shoulders of the employee and the people looking to retire. So that's why it's all the more important that people have someone to give them advice and help them navigate through what kind of income can I get from my 401k? Because for a lot of people, they started off, they watched that money grow. They watched it, for those that are near retirement or right there, they watched it go up and then fall in 2000, 2001, and 2002. It grew back up, and then they watched it fall in 2007, 8, and 9, and it grew back up, and they watched COVID come along, and then they watched 2022 come along when Jerome Powell started raising interest rates, and now they're seeing that we're at new highs and things are looking good. But that money to them is not something that they really have ever counted, because they knew they couldn't spend it if they were ever going to retire. And now that they've kind of gotten there, they're saying, what does this mean?
Right.
How much income can I draw and not outlive it? And how can I plan in the future for the fact that we know that markets go up, we know markets go down, and they will continue to do that for the rest of time. So how do we build a portfolio? And that's where we come in to navigate all the ups, the downs, the sideways, and all the emergencies and things that are going to come up over one's lifetime.
So people have a 401k from a previous employer or employers. The next question is, do I convert that over to an IRA? How do we make that decision?
Yeah, so that's a really interesting question that you asked. So let's say that I am 55 years of age and I leave an employer I've been with for a long time, and I have a pretty good size 401k over there to go to a new employer to work my last 10 years. If I want to, I can leave part of that or all of that money in that old 401k plan, and after age 55, I can tap that because generally it's age 59 and a half before you can tap your 401k without a penalty. But because I hit 55 and I left that behind, I can now take income payments out of there if I need to for a while, or should I have an emergency where I would need to do that without having to pay the penalty. Now, make no mistake, you still have to pay the taxes, but you don't have to pay the penalty. For some law enforcement officers in some areas, it's age 50 that we get to do that under certain guidelines and rules. Don't take that as a blanket statement. But just know that there's a lot of options there. Many times it does make sense to take it out of the 401k plan. In fact, most companies would prefer that you take it out. And you have a couple of options there. You can take it to a traditional IRA on your own after you've left that employer, and you can roll it over and not pay any taxes. And you have a whole world of investment options that you would not have inside the 401k. Now, you do have the option to roll it over into your new and current 401k. I would say that leaving it behind for the most part is probably not what you want to do, because you're going to not be as active in looking at that as you will your current 401k plan at your new employer. So what you do with that, there's a lot of factors again that come into play, but just know there's a lot of flexibility there, and we have a lot of options to help you maximize growth, give you the recognition and security that you need of what's going on inside that 401k until you get to retirement, and also along the way help you make tweaks to the plan to really get you where you want to go and live retirement the way you want to.
We're talking about building blocks to a successful, well-rounded retirement plan with Randy and Jake Floyd of Floyd Financial Group. Of course, we've covered Social Security, pensions, we've covered 401ks and IRAs. Many people have money in stocks and bonds. What do we do with those, and how does that differ when we get into retirement versus when we're working?
Sure. One thing I would like to run back here right quick and talk about, Jeff, is if you are someone, that's 55 and older and you're looking to do a Roth conversion, I would say that, if you've got that 5 or 10 years ahead of you, you've been thinking about doing that, and we have to look at your tax what-ifs, and lots of things come into play before I would say, let's just do it. But it could be something that could be very beneficial to those people looking forward, because I don't think taxes are probably going to go down, but it's something else just to think about when it comes to 401k rollovers, IRAs, and Roth IRAs. It's just something that should be considered, whether the Roth could be a good move for them, for each individual or not. And we just do that on an individual basis. We can't do that as a blanket number. Every case is different again.
So when we get into retirement, if we do have stocks, bonds, and alternative investments, maybe we've got cash, things like that, little real estate, how do we figure what we should do with those things? I would think that maybe, at least with the stocks, those are a little more risky than a lot of people are comfortable with once they get into retirement.
We want to have a diverse portfolio for sure. A lot of people that are in the rental business love the rental business, and they want to stay in that business for a very long time, maybe up until their mid-70s or even beyond. And then there are those that try the rental business and they go, ugh, I wish I hadn't done that and I'll never do that again. So
right.
There's two schools of thought on that and how real estate works. There are some options within real estate other than just having your own personal property that you own and rent. There's many different things to talk about there. There's these things called real estate investment trusts. We have to be very careful with real estate investment trusts and where we invest money there. They're illiquid. They do pay income, but sometimes they're paying you back with your own money. So we have to be careful about what REITs we might use. Stocks, on the other hand, there are some stocks that are very risky, and there are some that are not. So case in point would be, we've had stocks that over the last 2 or 3 years, in fact, one that comes to mind was a car company. I won't name it specifically, but the day it opened, it was worth $100 billion.
Oh, yeah, I know the one.
And they hadn't even delivered a vehicle.
Yeah.
They were more valuable than all the other 3 big car companies in America combined on day one, and they hadn't delivered a vehicle. So you got to be careful of stocks and speculative stocks. But, there's a whole bunch of companies out there that are not going out of business. Yes, do we have ebb and flow in the market? Yes, we have up markets, we have down markets, we have corrections, whatever you want to call them. But, you can make some really good decisions, with some guidance from a professional that looks at that stuff all the time. And we can make good decisions about what stocks to own. And nothing really has outperformed equities, especially as a hedge against inflation, ever. I mean, it's the best thing out there. When it comes to bonds, Jeff, that you had just alluded to, bonds for the longest time were potentially a losing proposition because we had such low interest rates or low coupon rates on bonds that when interest rates go up, if you have say you have a 2% yielding bond and interest rates go to 5%, which is kind of what happened as Jerome raised interest rates this last time, bonds got devalued because if you wanted more than your 2% payment and you wanted to sell that bond, you had to sell it at a discount to make it yield closer to 5 or nobody would buy it. The opposite is also true. Now bonds might be a really good play for the foreseeable future because as Jerome Powell starts to tick down interest rates, we'll probably get price appreciation. Plus, we're also able to get 4 and 5% yield on bonds right now. So for CD investors and retirees, it's been a really good time to be in the bond market.
Randy, Jake, before we continue our conversation, I want to talk to our listeners for just a moment. If you're not sure that you have a well-rounded financial plan, if you want a second look at that, or maybe you don't have a plan at all, you're wondering what to do, well, I'll tell you what you can do this weekend. Call 417-889-7233. That'll put you in touch with Floyd Financial Group and request your no-cost, no-obligation Floyd Financial Group Retirement Review. As I said, it's not going to cost you a dime, but it could be the most important phone call that you'll make all year. So that number again, 417-889-7233. Go ahead, give it a call this weekend. Get on the calendar there with Randy and Jake to get the questions answered that you need to put you on a path towards a confident retirement. As I said, no cost, no obligation, and certainly there is no judgment. Randy and Jake will meet you where you are. So while you're thinking about it, make that call this weekend. Leave your name and telephone number. If you'd like to call here in the weekend, Ashley will give you a call back on Monday and set up an appointment for you to sit down with Randy or Jake in a no-tie zone. Just have a very casual conversation. Once again, that telephone number, 417-889-7233. You can also request your plan online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. We're talking about what's involved with a well-rounded retirement plan, and we'll continue that conversation in just a moment when our show continues here on 104.1 FM KSDF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpas, Randy and Jake Floyd.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and continuing in this segment, we'll be talking about, again, the building blocks of a solid foundation for retirement.
And we began the conversation here talking about an income plan, but I think at the beginning, we talk about a lifestyle plan. We've got to figure out how much money we need to survive in retirement. So what sort of a conversation do you have with people, Randy or Jake, to determine how much money they're going to need before we do that income plan?
Yeah, sure thing, Jeff. I mean, that is really one of the first things we talk about. When people come in and we don't know them when we're sitting down for the first time, we have a process called discovery. And really what we want to know is we want to know and understand about those people. What makes them tick? What's important to them? What are their family dynamics? What are they really looking to accomplish? And that all helps us determine, a budget. We look at that. We look at the budget two ways. Number one is, what does it take to keep the wolf away from the door, as my dad used to say, and keep the family fed? Right. And then how much mad money or fun money do we want to have on top of that? So there's really kind of a two-tier process to budgeting. And then from there, we get into actually putting together the financial plan and determining how much income and what acceptable withdrawal rates look like.
So in the beginning, you're going to determine what lifestyle they hope to have in retirement, and that can be all over the map too, where some people may want to travel the world, go to Europe, Southeast Asia, visit the rest of the world. Other people may want to just fish off the bank, so it really does require a whole different level of income for those two different scenarios. So let's talk a little bit about risk tolerance. Once we've decided what we want to do in retirement, we've gotten an income plan going, we're talking about investments to support that income plan. I would imagine that a conversation about risk tolerance comes into play. And there's a difference between risk tolerance and risk capacity, right?
Yes, there is. So the risk tolerance is one of those things where it really comes down to this. All right, Jeff, it comes down to how do people feel about their money is right. A large part of it. Now, we have to stay within the realm of reality, too, as to what they're going to withdraw. And then the capacity to take risk, really, it almost has to be dissected two ways, too, because there's the actual monetarily fiscal capacity to take risk, but then there's the mental and the emotional side of having capacity to take risk. Because I have some people come in here, and there's no right or wrong, okay? It's just kind of funny how widely it ranges. I have some people that come in and say, yeah, I don't care how much risk you take. If we lose it all, it's okay. Well, I don't think that's going to be the case, actually. Yeah. But that's right. How far they say they're willing to go.
Right.
And then we have the other side of that, and that is, if I ever see 1 cent of my money go down because of a market, I don't like it.
Right.
And then we have everybody in between, which is obviously on any bell curve where the masses live, right? And so what we have to do is determine for people on 3 planes their risk tolerance that we have as a fiduciary for them, number one. Number two, what fits within their portfolio and their budgetary range. And then finally, that third plane is emotionally, how do they respond, and how can they take it? And I will say this too, that changes over time for people in two different ways. I would say that if you retired in 2006 and then 7, 8, and 9 came along,
yep.
you probably have a different perspective than if you retired in 2009 and got to ride a 425% uptick in 11 years.
100%. I've talked to those people. They all have different perspectives, I'll promise you.
But I will say this too, time in retirement, or time in grade, I would call it, and seeing how portfolios respond and how we respond also gives people greater comfort looking forward with their risk tolerance emotionally.
I would imagine in these interviews, too, that many times you speak with couples, man and a wife, and I would imagine that also you find that they have differences in risk tolerances. You talk to the guy and he says, I'm all in. And then you ask the woman what she thinks, and she says, I think he's an idiot.
Well, you heard the story about the guy that went to the doctor, right? And he was having some problems in his head, and the doc said, you need a brain transplant. And he says, can we really do that? He says, oh, yeah, we can do that now. He says, you need to go out and select yourself a brain and come back and see me. He says, well, where in the world do I find a brain? He says, well, go out to the internet. Brains are us. So he said, so they go out. He gets out on the internet, and he goes out and he picks his brain. He comes back to the doctor. He said, I noticed one thing. When I was out trying to select my brain, he said, all of the men's brains were much more expensive than the women's brains. He said, can you explain that? He said, of course. He said, the men's brains have never been used.
They got low mileage on it.
I thought you were going to say that the brain was Abby normal there for a minute, for anybody who's seen Young Frankenstein.
Yeah.
I
was trying to figure out where we were going there.
I always like to tell that story because about the time I get to the punchline, the women get all burned up, and then we say, actually, we know that the women are whole thinkers and men are more linear thinkers, right?
And both of those things are good.
Both are good, and so we like to have consensus when we do plans for people.
So many times there can be a difference in risk tolerance, and of course the goal is to come up with a plan that will satisfy both people. We're talking about what's involved with a well-rounded retirement plan with Randy and Jake of Floyd Financial Group. We've talked about the income floor. We've talked about risk tolerance. We've talked about investments to support the income plan. Let's talk about something else that's very, very important, and that is going to be a tax plan. How do you tackle that problem?
Well, taxes are one of those things that is very taxing.
So, I know.
Anyway, so, depending on how they're set up and what their portfolio looks like and how much of that money's in IRAs, Roth IRAs, non-qualified accounts, maybe real estate that they own directly or maybe through real estate investment trusts, the plans are very diverse and varied. Also, we got to look at what type of income do people really want and need to live on. And so when we look at that, it can be that, let me say this. I'll just say this. Today, the minimum tax bracket for the Fed is 10% on roughly the first $20,000 you make as a married couple. Then after $20,000 up to about $94,000, you're in the 12% tax bracket for the Fed. And then north of that $94,000, you go to the 22% tax bracket. There's a 10% jump there. Most people are living and able to live in that 12% bracket. So to get and stay in that 12% bracket, you need to have about $115,000 if you're married and filing jointly. About $115,000 will land you solidly inside that 12% tax bracket. So after taxes, people have a good amount of money to spend there, and they can be in the $7,000, $8,000 a month range in money to spend. And for a lot of folks around this neck of the woods here in the last bastion of sanity, that can work for them. But when we get outside of that, we have to start paying the piper. Now, there are ways, like I said, especially if you've got a large 401k, if your income is not taking you up north of that 22% tax bracket now, we might want to entertain the fact that we might want to start to convert some of our IRA money to Roth IRA money, because we have a 5-year cure period, and then after that 5-year cure period, everything that ever comes out of there doesn't even show up on your tax rolls. So tax management is something that we can really look at and figure out. This also comes into play a lot of times for health insurance for people that are not yet 65 and wanting to retire. How do we find some money that we can spend on health insurance and have for income maybe for a couple of years that don't ring the tax collector's bell? So there's just a lot of ways to look at taxation, and we love dealing with and messing with this stuff because it can be a tremendously different outcome. It's kind of like when people come in and say, hey, I want to pay $70,000 for a new SUV, and I want to write a check for it. And they have an IRA that they want to pull it from, and they're already making $100,000 in retirement income. I'm going to say, well, rather than paying for it, let's pay for it over time, and we'll do the math. And even if you have to pay a couple of % interest, you're probably going to be ahead to make payments rather than putting yourself in the 30% tax bracket by just paying for it. So a lot of things come into play on tax planning.
And right now we're in a historically low tax rate, of course, but that could change with the political situation, of course, if the Tax Cuts and Jobs Act of 2017 expires. So I think tax planning right now is more important than it almost has ever been. Let's move on to the next building block here of a successful retirement plan. Randy, you sort of touched on it a little bit, and that is going to be healthcare costs. Along with taxes, healthcare costs, I think, are probably one of the biggest expenses that you'll have in retirement.
Yeah, it's been said that 80% of your health costs will occur after age 65. When we look back over our shoulder and say, well, I've been healthy all this time. I haven't had much any. And, I'm one of those guys. I've been very fortunate. I've been very blessed. My health has been good most of my life. I've been able to work for 50 years and and come out, pretty good.
And you live to tell about it, yeah.
And live to tell about it, So it's one of those things that it's hard to plan for, but we have to have the discussion about it. Now, for most things that are acute, things we're going to get over, Medicare does a pretty good job of paying for most of that stuff. There are, once in a while, those dread disease things that come along where we have to have, experimental medication and brand new medication that can cost us a lot of money. But a lot of those, that donut hole, they call it, is being closed for Medicare. But when it comes to long-term care, that's where we need, help with activities of daily living that are going to be permanent in nature. We're not going to get any better. That's the discussion we all need to have as to how are we going to plan to fund that. And that's one of the discussions we have with everybody, just to make sure they've thought about it.
So Medicare is a pretty good insurance plan. And of course, once you reach 65, you get Medicare Part A. That is going to cover your hospital visits. Medicare Part B, that's the supplemental plan, or at least I always get confused on this. We'll call it Part B, that covers the doctor's office visits and things like that. But then you've got, drugs that you need to be aware of, and that can be a Part D on that. And then there are all sorts of these other plans, too. There's a Medigap policy, so there's a lot to figure out when it comes to Medicare. And Medicare doesn't cover everything, Randy. I understand that it doesn't cover, dental coverage and hearing aids, things like that?
Yeah, there's a lot of that stuff that is not covered. However, I will tell you that if you opt for Medicare Part C, as in Charlie, that's an Advantage plan, and those things today have help for a portion of long-term care up to 100 days in some cases. They also have dental plans now that will pay, are you ready for this, up to $5,000 worth of dental work when you get signed up. So there's a lot of things to consider, and we can certainly help people navigate that. And we got, Tony Gossard, a guy we use a lot for that. That's his profession and what he does, and he can help people navigate that to where they can get exactly what they, to the best of their ability, what they can get.
And I want to touch on this long-term care payment system too. Randy, I understand that you did a seminar that talked about the 4 ways to pay for that. Can you briefly tell us about those 4 ways?
Yeah, so 4 ways to pay basically talks about, if you end up in a nursing home, and today it's about probably $7,500 to $8,000 a month for skilled nursing. There's 4 ways to pay out of your hip pocket. It's one way. That's probably not the way most people want to do it. Number 2 is if you're a veteran, under certain circumstances, there are veterans benefits that can help you offset the cost. It's a reimbursement program. It's not insurance, but it's a reimbursement program that you have to qualify for both health-wise and asset-wise, but there's some good benefit there. There's also long-term care insurance that's out there. And then finally, Medicaid is the 4th way to pay. If people want to talk about those and really understand what those 4 options are, it's something we're very well versed in, and we're happy to sit down and talk with them about that during any of their consultations.
We're talking about the building blocks of a well-rounded financial plan with Randy and Jake of Floyd Financial Group. We've talked about an income plan, of course, that consists of things such as Social Security and pensions and whatever investments that you may have. We've also talked about investments to support that income plan. We've talked about a tax plan, and we're touching here on healthcare needs and long-term care. If you have questions about your retirement plan, you're not sure whether it's well-rounded enough, you want a second set of eyes on that, or maybe you just want to start from the beginning, once again, we're offering a no-cost, no obligation, and no judgment financial review with Randy and Jake at Floyd Financial Group. How do you get yours? Well, you pick up that phone, you call 417-889-7233 right now. As in this weekend, leave your name, your telephone number. Ashley will call you back during the week and set you up with an appointment to sit down with Randy and Jake and talk about your individual situation. It is a one-on-one conversation. It is a no-tie zone. Just a chance for you to get your questions answered, to put you on a path path towards a confident retirement. Once again, it's not going to cost you a dime. Why wouldn't you make that call this weekend? 417-889-7233 to set up your appointment. You can also request your appointment online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Gentlemen, time for a break. When we come back, we'll wrap up our conversation here about a well-rounded retirement plan. We'll talk about estate planning and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about 19 money mistakes people make in retirement.
That's exactly right, Randy. But before we get to that, I want to wrap up our conversation about this well-rounded retirement plan. Of course, we talked about the income plan, investments to support the income plan. We've talked about taxes, health care, long-term care costs. Let's wrap it up with an estate plan. So what is involved with an estate plan, and does everybody necessarily need an estate plan?
So everybody needs an estate plan. Some just need to be more elaborate than others. That's
Okay.
what I would say about that.
Depends on what you got, I guess.
Yeah, so basically, what is an estate plan? An estate plan is, hey, what happens to my stuff when I die? Is basically what it really amounts to. Who gets it? Do we want them to get it through probate or without probate? Normally we want to keep people out of the courtroom, right? And keep our kids out of court and going to a probate judge and having them maybe hire an attorney and do all sorts of things like that. So I would say this, there are basic estate planning tools that people can use. Now, I want to tell people here, I am not an attorney. I'm a financial advisor. We do have an attorney in-house here that can help you with estate planning. But basically, when we go and we want to avoid probate straight up, we can use what's called transfer on death for vehicles and stock accounts. Mm-hmm. We can use pay on death at bank accounts. Right. We also can use what's called a beneficiary deed here in the state of Missouri that basically says I own it until I draw my last breath, then it goes to my children or child or children. And then we also have beneficiary designations for IRAs and 401ks, and all that bypasses probate. The thing that I would say is while all those are very straightforward and work very well, there are certain caveats that come with beneficiary deeds, and there's also certain caveats that come with POD bank accounts, and that's something that you should talk to an attorney about because there's just certain things. I'll give you one case in point. If I have 5 kids and I pass my house to them on a beneficiary deed and all 5 of my kids are married, that means that if they want to dispose of that property, all 5 kids have to agree along with the spouses in the state of Missouri.
Right.
So now we have 10 people that need to agree on something.
My gosh.
Many times we can hardly get 2 people to agree, let alone 10. So that's just one caveat, and I won't go into all the other ones, but it's something that should be explored for sure. So estate planning also really comes into play. Let's say that we've been married before, maybe we're widowed, and we had kids with that spouse, and then we've been remarried, and we have kids with this one, or what we want to do is avoid anybody being disinherited or anybody getting an unfair advantage on the other side, or you want to make sure that your new spouse has availability to live in your house until maybe she can't or she passes away. I mean, there's just all these things that can come into play as we have lived our lives and we've been on the planet 65, 75, and 85 years. Most of us have created a mess somewhere. and we have to...
More than one in many cases, more than one.
Yeah, and we have to have a document that addresses those things. And it's almost kind of, I won't say it's a living document, but what it does is we've thought it through and we've thought about all the contingency plans that need to be put into place. If somebody dies out of order, if I lose a child and they have grandkids, how do the grandkids get the money? Do we plop it all in their lap, or do we put them on a plan that says, hey, you get so much at 25, 30, and 35? I mean, there's just all these things that come into play with a good, well-constructed trust or an estate plan. It will address all those issues.
So that's the big question, will versus trust. And you've said before in the program that a will usually means probate, and probate means filing a lawsuit against your kids many times, or at least it feels like that. So there's a lot that goes into estate planning, and it is a very important part of a well-rounded financial plan. So once again, I remind folks, if you're not sure about your well-rounded financial plan, if it's got a few sharp corners to it, you'd like it to be more well-rounded, call 417-889-7233 and request your no-cost, no obligation, and no judgment financial review with Randy and Jake to create that well-rounded financial plan. Okay, gentlemen, let's dive into a topic here I think that will probably continue next week, and these are money mistakes not to make in your first year of retirement. Everybody's excited about retirement when they first get into it. And of course, in the first year, you could make some mistakes that you may not be able to recover from very easily. The first one is being too conservative with investments. Why may that be a mistake in the first year of retirement?
Depending on, we can't really choose when the market decides to give us growth. We can't ever be too aggressive or too conservative. What constitutes being too aggressive or too conservative varies widely from person to person, so I can't really give you straight specifics. But if the market's going to give us 100% growth over the next 10 years, but we have no idea when that 100% is going to come, then it would stand to reason that we need to capture that. And in order to capture it, we need to be invested in a way where we can capture at least a good portion of that. Being too conservative, especially when we have, on the back of inflation the way it's been, that can eat up your buying power. And if we're not growing enough to outpace that, I guess, we can feel it in our wallets. And I know I have lots of clients that are feeling this inflation right now. I hear it almost every day where people come in and it's just like, man, it costs, it used to be $200 at the grocery store and now it's $300, $350, things like that. That money doesn't just come out of nowhere. Making sure that we're able to capture at least some of the gain whenever there's gain to be had is very important.
And I think you also have to consider that people are living longer than they used to. So there's a longer retirement span that you have to plan for, and without growth, and that means riskier investments, you might be in trouble. So if I'm hearing you correctly, all during retirement, you should have some element of risk. But what you're saying is that the element of risk may go down as you get further into retirement?
Yeah, I would say as a general rule, that's probably true. Although, again, it's very difficult to give blanket answers,
right.
Certainly over a radio show. So I don't want anybody to take this as investment advice to them. But yes, generally speaking, as we get older, it usually makes sense to take less risk because we can't afford to make big mistakes once we're into retirement. We can't afford to have to go back to work and that kind of thing. But it is important not to be too conservative, especially if interest rates are low. Right now, it's nice because interest rates are kind of high, and so being conservative actually pays fairly well at the moment. However, people have short memories, and just 18 months ago, it paid zero to be conservative. We can't count on that interest to always be here. So those are always things that we're looking at when we're developing plans and as we're monitoring plans. Hey, what's the opportunity cost of this money being safe? And, there's obviously more opportunity cost if interest rates are low than if they're high. And so, right now, again, it's a pretty good time to be a saver and a bank kind of person. However, I think the days are limited for how long that will last.
Money mistakes that people make in the first year of retirement. That's what we're talking about. The first one is being too conservative with investments. The next one here is not creating a retirement plan. Boy, I think that is a big one, trying to fly by the seat of your pants.
Yeah, I would agree with that, Jeff. Doing that, if you were going to take a trip from here to, let's make it someplace complicated. Where can we go? We could go to... Where does the groundhog live? Punxsutawney Phil?
Punxsutawney Phil. He's in Punxsutawney, Pennsylvania. Yeah.
Yep. All right, there you go. So I have no idea how to get to Punxsutawney, but if I did sit down and create a map, I could probably get there.
Yep.
And that's really what we're talking about when we talk about creating a retirement plan. We want to have a roadmap. We want to have an idea of what's happening. We want to monitor that. We want to change it when it needs to be changed. So, it's just one of those things that you got to have. You got to have a plan. And you know what they say, failing to plan is planning to fail. Right?
That's exactly right. And on that way to Punxsutawney, Pennsylvania, too, there could be some detours and some road construction there, which could cause you to change course a little bit. So I think having a plan that not only accounts for a smooth trip, but also one in which there are going to be some detours is very, very important. So you got to have a plan to begin with. I think that is number one. The next one here is going to be overspending. Now, people get all excited. I'm in retirement right now. I built up all this money. I'm just going to go out there and spend like a drunken sailor. Not a good idea.
We don't have many drunken sailors.
No, I bet not in Springfield.
not as clients, but man, heaven knows there's some drunken sailor spending going on out there in this economy. I mean, going and buying at discount stores at 30% interest when prices have doubled over the last 2 years, I think would qualify as drunken sailor spending.
Yeah. First and foremost, if we were giving advice to drunken sailors, we would be outside our fiduciary duty.
I would imagine so. don't have a lot of sailors out there in Lake of the Ozarks, do you?
We do serve beverages here when you come in for your consultation, but none of them are alcoholic. So if there's anybody from the SEC listening or anything like that, we don't do any of that. So
that's right.
But in all seriousness, the spending is pretty wild out there right now, and I think that will not continue forever. A fool and their money are soon parted. Right? If you spend like that, you will eventually be caught in a bad situation. The question is, how much longer can it last? That's the trillion-dollar question, if you will.
Yeah, and I think when you get into retirement, a lot of people want to do improvements on their home renovations and so forth, and, they just spend out of control. That is a big problem.
And again, we address that with the budgeting and stuff on the front end. For our clients and the people that we help, we often say, well, that might be a little aggressive.
You put it nicely, basically, instead of you're out of your mind.
Right.
Retirement mistakes that people make in the first year of retirement. Next one is going to be sometimes taking too many risks.
One thing I would tell you that we can relate this to, which will eventually change. My dad used to always say, well, Randy, every dog eventually has its day. And what he meant by that was, Montgomery Ward's used to be a big business.
Right.
Every Walmart will eventually become a Kmart.
That's right.
Kmart, yeah.
And Sears used to be a big business, and they sold everything, and now they're no more.
Right.
So once in a while, we'll have somebody come in and say, well, I think we should put all of our money in O'Reilly. Well, if you were to look back over the last 15 years, that would have been a very wise move. But if you'd put all your money into Sears or into Kmart, it would have been a very horrible move.
Sure.
So, it's one of those things that you can't afford to take too many risks, while we can always look back and say, dadgummit, if I'd have put all my money in Bitcoin 5 years ago, I'd be a multimillionaire
even 5
today.
months ago at this point.
Yeah, it's true. Mm-hmm. So, hindsight's always 20/20. So, we can name 5, 6, 7 stocks that have just done fabulously. But remember, there's probably 5,000 different stocks a person can invest in out there. And many of them you wouldn't have wanted to invest in.
So taking too many risks is one of the things that you do not want to do in the first year of retirement. And finally, for today, and as I said, we'll continue this conversation next week, there are a lot of scams out there that people can fall for in the first year of retirement. And they're becoming more and more sophisticated, offering unbelievable returns.
Yeah, you are certainly correct about that. I've often told people, when somebody says, well, we're going to guarantee you 12, 13, 14, 15%. Most of us have been on the planet 60 plus years that are ready to retire, and you know better than that. But again, I understand that some of these people are very, very good at separating people from their money. Now, I'm not usually much of a movie promoter on this show, and you have to kind of watch some of the language in this movie, but if you haven't seen The Beekeeper, you probably should, because it deals with this very subject matter.
You mean greed is not always good?
Greed is not always good.
But I thought Michael Douglas said that, okay.
Well, there's some very believable scams out there, and they target older adults. And as you said, they'll promise them unrealistic high returns, and people do fall for that sort of thing. So I think that really the answer here is to talk to a pro. If you get these phone calls, or you get some solicitation in the mail about these returns, you certainly should consult somebody else about them, because more than likely they're not going to be true. FTC data shows that last year, 2.4 million people filed reports of these financial scams, so don't be one of those. We're talking about the money mistakes that people make in the first year of retirement with Randy and Jake Floyd at Floyd Financial Group. And guys, we're going to continue this next week, but in the meantime, I want to remind people before we go today that if you'd like more information about anything that we've talked about on the show today, or you want to request your no-cost, no-obligation financial review with Randy and Jake, you can get that by calling 417-889-7233. 417-889-7233. Go ahead and make that call this weekend while you're thinking about it. Request your appointment, leave your name, your telephone number. Lovely Ashley will call you back during the week and set you up with an appointment with Randy Jake to talk about your individual journey towards a confident retirement. Once again, 417-889-7233. You can also request your plan online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Well, guys, we just get rolling, and then before you know it, somebody comes in and says, are you guys about done? We got another show coming up here. So we've had that happen to us. So for Randy and Jake, I'm Jeff Shade. Have yourself a great weekend, won't you? We'll talk to you again next week week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor registered in the state of Missouri.